Let's talk money.
Hello and welcome to another edition of Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. Now, if you've been following the news headlines, you would know that finally, after a wide consultation, market regulator SEBI has allowed the launch of a brand new investment product. It is, as of now, simply being called a new asset class. Now, this new asset class is a new investment vehicle that mutual funds will be allowed to introduce to the market. It has certain basic thresholds. For instance, you can only invest a sum of a minimum 10 lakh rupees and above. The question is, why do we need a new asset class? Is there a missing gap or a missing link in our portfolios that a product like this perhaps will fulfill? Well, joining me to answer a lot of these questions and, helping us get through the haze are Ashish Shanker of Motilal Oswal Private Wealth, as well as Ashish Somaya, CEO of White Oak Capital AMC. Gentlemen, thanks very much for joining in. And I think it might be slightly confusing for our viewers because we have two Ashishs as the experts on the show. But always a pleasure to have you both. You have, wealth and years of experience between you. So I think this will be quite helpful. So to start off with, a new asset class. What does it even mean, Ashish?
Yes, I think, first of all, I should congratulate, or compliment our regulator because from what I know, it was not an idea which was started by the industry. I think it's a great initiative by the regulator themselves. The reason why I say that is because, it's quite innovative. Look, that over the number of years, the mutual fund regulation, a lot of water under the bridge, widely considered to be very successful industry, well-regulated, scaled over the number of years, and very retail-friendly, as little as 100 rupees, standardized products, what is large cap, what is mid cap, everything is very well defined. So over the years, the regulator has made mutual funds very standard, very, commoditized standard products, which are amenable to subscription by the, most investor who's most, say, unaware or, doesn't need to get into too much detailing beyond the point. But then that as investors, as per capita income rises, as investors' knowledge increases, as their, quest for different risk-return combinations comes up, that investors start looking for, products with, say, more concentration in their portfolios, products which use sophisticated derivative strategies to hedge equity portfolios, or for that matter, say, somebody wants to take more risk, they want to lend to, lower credit kind of products. So because the mutual funds have been, made for retail investors, what happens is that a lot of these sophisticated risk-return combinations, they end up going with, say, registered investment advisors, PMS managers, AIFs, etc. And for a fact that a lot of these other segments, they don't have that much of a long history of regulation. Second thing is that obviously now you have mutual funds, 45 players, all been through, very strict entry barriers in terms of how many AMCs can be. So what the regulator has done is that a lot of these other risk-return combinations, which asset managers had to venture into PMS, AIF or RIA licenses or, baskets, etc. What the regulator is doing is probably casting the net wider and saying that, okay, these regulated AMCs have a long history.
Sure.
Let's give them a little bit more leeway and under the mutual fund structure itself, launch things which were otherwise being done in other, regulatory platforms.
Right. So, in fact, Ashish, I do want to spend some time contrasting these various products beyond plain vanilla mutual funds because they're all out there. And Ashish Shanker would know because, he has decades of experience helping people manage their portfolios, managing wealth. And I guess, Ashish, this is a fair point, right? And even retail, sometimes these definitions need to be perhaps relooked at. What is retail? Who is sophisticated? Who's not? Because the mass affluent segment also has a fair amount of money at their disposal, lying in bank accounts, and they're waiting to put this money to better use. And the tendency at times is that, okay, mutual fund to hai mere paas, mutual fund sahi hai, but maybe I should try crypto, maybe I should try something new and fancy in the market. What are your thoughts and the experience you've seen?
So, in fact, you just took words out of my mouth. I was going to say that, this new asset class marks two things for me. One is coming of age of the industry and coming of age of the Indian investor. Often, condescendingly comments are made that retail money is dumb money. But actually, if you look at the last few years, retail money has turned out to be the smart money, right? The global institutional money, in a sense, has lost out on the growth in the Indian markets. So clearly what is happening is there's a confluence of many factors. So if you look at the demat account additions, right, you're at 17 crores from 3.5 crores pre-COVID. So many people have come into financial assets as an investment. Secondly, if you look at the growth of the mutual fund industry, I mean, today you're at 60 lakh crores.
Yeah.
You look at the growth of the AIF industry, right? The Cat 2 has become a very large category where you can do sophisticated investment products, like Ashish just mentioned, credit, to name one of them. So I think this marks the coming of age of the Indian investor as well as the industry, where now the regulator is acknowledging that, look, the Indian investor has the ability to distinguish between different products at a risk level as well as at an outcome level. So mutual funds clearly is defined as a vehicle for the masses, which means that you have to be very cognizant of the risks that you can allow them to take, because at the end of the day, you don't want a situation where people invest in such a large vehicle, small sums of money, and that ends up in an outcome that is not so desirable, right? On the other end, there are vehicles for ultra HNIs like the AIFs, where the minimum is 1 crore, where depending on the category of fund, you are allowed to do different strategies, more complicated, sophisticated strategies. So this I see as an in-between vehicle, which was much needed, where it will have some rules which are similar to the mutual fund product, but at the same time, it will have greater flexibility. So, yeah, so to name one product, internationally, you have something called inverse ETFs. Right. So if you're bearish on a particular sector or on a particular set of stocks, you can short it with leverage in a fund format. So those are inverse ETFs. Now, obviously, those carry much higher risks. So this will come with a slightly higher minimum, but it will also allow you to take more risk than the plain vanilla mutual fund, where the rules are much tighter.
So let's get to the rules, actually, just so that we have some clarity. And I must point out that I think what we now have is, a SEBI document which came out immediately after the last SEBI board meeting, which kind of lays down the broad contours, but the more granular details are still awaited. So it's early days, but we'll work with what we have. And to start off with, the threshold is very clear that to invest in this new asset class, you need to put in a minimum of 10 lakh rupees, right?
That's right.
Ashish, if you could just expand on that. Is it for one, and they're calling this as investment strategies, right? It'll be called, it'll be individual strategies. So is it across one strategy, multiple strategies? How does it work?
Yeah, so from what I understand, first thing is clear, it's in a mutual fund format. So typically every mutual fund has a trust. So it's under the mutual fund format. But yes, to make sure that it's not seen to be like the normal mutual fund you're used to, because these are different strategies, maybe with more sophistication, different risk return combinations. So to distinguish from a typical mutual fund, it is called investment strategy, right? The other important thing, like you said, the minimum is 10 lakhs. But what I understand is that the 10 lakhs is at a fund house level. So for example, as White Oak, if we were to have 2 or 3 different new asset class investment strategies, then it's not that we need 10 lakhs from let's say Surabhi has a PAN, right? You are one individual. We don't need 10 lakhs in every strategy. We need 10 lakhs at a fund house level from Surabhi. So it can be in 3 different strategies. So it's 10 lakhs at a fund house level. At
an AMC level.
Yes.
So that's one important sort of aspect to keep in mind. Let's talk about some other rules that we perhaps know right now. I think, one thing that came into play was that it will allow more varied use of derivatives, right? So Ashish, what's the latest on it right now? Because mutual funds do have some restrictions with respect to leverage and even derivatives. So what's new here?
So look, a lot of the final details will get sketched out over a period of time. But what it allows you to do, this new vehicle, is, for example, there used to be credit funds, and then there were new rules which came out after certain incidents that happened. So here you will have the flexibility to go down the credit curve. So that is point number 1. So you have the ability to take greater risk on the fixed income side. Second, as far as leverage is concerned, my initial understanding is you can take up to 25% exposure net in derivatives. Right? So if you want to run a long short strategy, today a long short strategy can technically be run only
in the AIF
Cat 3 model, whereas in the mutual fund, most people run a arbitrage, which is a net off model, right, on the derivative side. So here you can technically take leverage through the derivative route. Similarly, you can combine different asset classes. And once the rules get edged out, I think this will also allow greater flexibility in terms of the position sizing. I mean, today for most funds, like for equity funds, you can't go about 10% in a stock.
In a single
stock. Whereas here, depending on the kind of
strategy,
it's 15%. So Here, depending
exposure
on the
to an
kind
individual, a single stock.
Single issuer or
individual
single
position.
stock or single issuer.
Or single issuer, any security if it's on the fixed income
individual
side.
position. And the other clarity that will emerge eventually is the taxation. I mean, if it is under the mutual fund umbrella, I presume that the taxation will be akin to a mutual fund, which means within the vehicle there will be no taxation. And whether it will get debt taxation or it will get hybrid taxation, we'll get to know later.
We need to see.
Yes.
Ashish, you want to add to this? I mean, just from what we know right now, the clear distinction between mutual funds, the plain vanilla mutual funds, and this new asset class. What else?
See, there are a couple of other things further to what Ashish said, which I have noted. One is, for example, if you see mutual funds, and just building on, I think, credit is an interesting space. So just building on what Ashish said, you know that in the past, credit exposure, buying lower quality credit paper was being done by mutual funds, correct? Then there was a point
to be
in
really
time,
risky in certain events, in certain cases. We all remember the memories of Island FS, etc.
So why did that situation boil down to, why did we come to that pass? Because we had to give up liquidity to preserve capital when the market went bad. And then the realization was that you should not be taking illiquid credit exposure in an open-ended fund. So then credit moved to AIFs. Now, what does this new asset class do? The new asset class basically says that although it's a fund structure, you're allowed to have lockups.
Oh, so this is a very important distinction versus open-ended equity mutual funds when I can get in any day and get out any day.
So mutual funds are not allowed to have lock-ins.
Correct.
Right? Even if you do a closed-ended fund, it is compulsory to list it on the exchange and enable trading and liquidity.
So at least I can, sort of sell my units on the exchange.
But in this new asset class, it says that you can have subscription windows, redemption windows, lockups, so many of those things. So that means that strategies which need to give up liquidity for some time, they are better done on a new asset class. Even for derivatives, mutual funds cannot be shorting anything. Like Ashish gave example of inverse ETFs. A mutual fund cannot be short. Mutual funds need matching positions.
Right.
You can do arbitrage.
Correct.
Right. The amount that you have long or cash position, only that much you can go short. You need to match it.
So net, it's more like a hedging strategy rather than taking a clear directional call and shorting.
But in the new asset class, you will be allowed to take directional calls on short also.
Right.
So
important distinctions,
So see, there is a clear understanding that as mutual fund experience, there are a few crores of investors who over the years have experienced mutual funds. Eventually, these people, when they become more sophisticated, they will want to take risk. So might as well afford a structure which will allow them to take risk in a more protected or in a more regulated
environment
manner rather than they going out and trying things.
Absolutely. So you don't want it to be a wild, wild west. You do want more innovation and perhaps a product that can take on higher risks for those who are willing to sort of, deal with that risk. Got that point, gentlemen. We have lots more to discuss. We'll take a break right now. But on the other side, the question is that fine, now we've understood what this new product will perhaps look like. But then there are already options in the market like portfolio management services, like alternate investment funds. So what's new here? What's the need? Is it really going to be different? We discuss this after the break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are discussing the contours of a brand new investment product that will very soon hit the market. It's called a new investment class. It's been launched by SEBI, and very soon you'll find mutual fund houses, AMCs, coming out with this product along with the regular plain vanilla mutual funds. So we've established, gentlemen, that the threshold is 10 lakhs, which brings me to, another issue. Someone who can invest 10 lakhs might, as I said, might have more capital at their disposal, can also invest up to 50 lakhs, which is the threshold for the next product, which is the PMS, which also has more flexibility. So, Ashish, your thoughts on how will this compare with a PMS, which also, promises to give you tailor-made advice and slightly more sophisticated risk-taking strategies, etc.?
See, there are two or three things. One is somewhere there is this belief that asset management companies and asset management regulation has been around for 30, 35 years. Whereas in the recent times, there has been a proliferation of large number of service providers, probably running into hundreds, if I'm not wrong, even into thousands, correct? Now, if you really look at it, there's let's say a PMS, which says that why you should go to a PMS is because, we have only 5 or 6 stocks. We run a very concentrated portfolio. Or somebody buys an investment basket saying that, I can run a PMS for 5 lakhs because you're just buying a basket of stocks and I'm curating the basket for you, right? Now, what happens is that it can come from thousands of service providers.
Yeah, I mean, and there are mutual fund houses who run their own PMS strategies. There are individuals who run their own PMSs. Yeah.
But look at it this way. Now, in this new asset class, the single stock limit is 15%, which means that I can run a 7-stock portfolio, which typically a PMS or an investment basket might offer. Right? Plus, it's a fund structure, which means that it's a proper fund structure which is not operationally as intensive as a RIA agreement or a PMS. Right? Because in a PMS, you're opening demat accounts, signing up individual client agreements, trading for individual clients. Whereas here you can run a highly concentrated equity portfolio, unlike a mutual fund.
Got it.
But on the other hand, if you see in a PMS, for example, PMSs have performance-linked fees, and you don't have to have a flat fee, you may have a performance-linked fee.
Sure.
Now, this new asset class or even mutual funds currently, they don't envisage a performance-linked fee.
Yeah, Ashish, so basically in mutual funds, we have these TER slabs. It's it has nothing to do with the performance of the fund, right? So you're saying this could be different?
Yes, because, like I said, disclaimers apply because we're awaiting the regulator to give us the final details of how new asset class will be priced. But I won't be surprised if it comes with some performance-linked fee-related innovation, etc.
Sure.
I mean, in fact, I hope it does, by the way.
But from me, the investor's point of view, a couple of things that I want to know, right? One, okay, I've understood that it is probably going to take on more sophisticated strategies, hopefully come out with better returns than plain vanilla funds. First of all, do you think, that is a realistic expectation to have? Because one is okay to pay a little more than a plain fund if you're getting slightly higher returns. And obviously, then B will talk about tax efficiency, but let's answer the A first.
Right. So I think, look, it's a little more nuanced than that. It's not just about better outcomes in terms of returns. It's also about managing the risk. Because like we spoke, a mutual fund doesn't allow you to take a directional call.
Sure.
Okay. So this asset class, based on whatever details we've got right now, it can combine different asset classes. It can combine a credit. It can combine a long-short strategy.
Sure.
So it can have a much better risk-return profile.
So again, to go back to the comparison, when right now we're only talking about the product and what can it potentially deliver in terms of the structure and the return. That flexibility is also available to PMSs. It's also available to certain categories of AIFs. So what will be the difference there?
Right. So look, so let's come to the definition of a PMS and AIF very quickly so that, it's easy for your viewers to understand. PMS is a go-between mutual funds on one side, which is a completely pooled, managed vehicle, and direct stocks on the other side.
Yeah.
Right? So you're basically entrusting your money with a manager who's operating out of your own demat account because it's not a pooled account.
Yeah.
Right? That is point number one. Second, there are a lot of boutique managers. So the rules are a little more relaxed for PMS. So there are a lot of boutique managers who are managing money for clients. So SEBI wanted to bring them under a regulated umbrella. Right? So if you want to go to a particular manager and that manager only has a PMS license, there's no choice. You have to go through a PMS. Right? AIF then becomes a more sophisticated vehicle because the minimums are 1 crore. So
1 crore is the minimum threshold for
AIF. For PMS, it is 50 lakhs. This becomes 1 crore. There, then you start moving into the ultra HNI, family office, institutional universe. And even within that, there are different categories which allow you to do different things, right? Category 1, Category 2, Category 3. So this new vehicle, if let's say the tax advantages are very similar to mutual funds and it does offer the kind of flexibility that we've been discussing, then there is a chance that it may cannibalize the PMS structure, because the PMS structure was invented so that you could take a little more concentrated positions, you could manage the portfolio with a little more risk as akin to a mutual fund, which is a more distributed kind of a vehicle. If this vehicle gets similar tax benefits as a mutual fund, then there is a chance it may cannibalize.
It could really trump then PMS and AIF.
It could cannibalize a PMS as well as an AIF, but the PMS will still have its charm, because if you want a boutique manager to manage your money, and that person has only a mutual fund, I don't know how widely they'll distribute this
someone
license.
Who customizes client by client, for example, that will only happen on a PMS.
Because this will still be a pooled vehicle. Remember that, right? It'll give you more flexibility, but it'll still be a pooled vehicle.
So, net, we have to obviously wait for the final rules to come through and really wait to understand what's going to be the taxation structure, because whether we like it or not, when investors do want to go in for products which can give good returns and are most tax efficient, because that's the reality of life. Tax does end up driving a lot of flows. So, gentlemen, before we come to the end of the discussion, I always ask for some executable ideas or tips or, just an understanding. And I typically like to find out where our guests are investing their own money, what is the new thing they're doing in their portfolios, if anything. Ashish, what about you? I know because you are you're running a mutual fund house, so I think there are certain rules that apply anyway. But what are you doing for your wealth?
No, we do exactly what we tell our clients. We invest in White Oak funds. So that is simple. So, I invest in, so anything that White Oak manages, I'm very clear, invest only in White Oak. But yes, when it comes to, say, private equity, crossover, pre-IPO, of course, I am subscribed to other managers because that's where they specialize. But yeah, all in all, I'm only into equity and real estate, nothing else. And I don't call myself a disciplined investor.
That's physical real estate?
Yeah, so I don't call myself, I mean, I would classify myself as an indisciplined and aggressive investor, so I don't think people should do what I do.
That's very interesting coming from the CEO of the mutual fund. But that's candid, and I'm sure you do a lot of homework and do your own risk assessment, which is really important. It is not a one-size-fits-all solution at all, which is where we need Ashish's advice as well, right? So Ashish, what's your recipe looking at the environment today?
I'm glad you reiterated that one size doesn't fit all.
Yes.
So I'm on record to say that I'm a 100% equity investor.
Okay.
My portfolio has only equities in it. There is no other asset class. And it's through a combination of stocks, mutual funds, AIF and PMS. So I have all products.
And what's the house call? I remember we had Ashish on the show, I think some 6-7 years back, just ahead of Diwali. No one was talking about gold. I'll never forget that call, a pre-Diwali show. And Ashish said at least 15% of your portfolio needs to move to gold, and the rest was history. What's your asset allocation now?
So in fact, it's interesting we're discussing this right now because this year in January, our report was titled Year of the All-Rounder. So we said we are bullish on equities, we are bullish on gold, we are bullish on fixed income.
Correct.
All three products. And that call continues.
Okay.
We continue to believe that you must have a multi-asset kind of an approach because equities, we continue to be positive over the longer run, but near-term risks are there in the system. Gold has done very well, and we continue to be positive on gold given the kind of geopolitical situation that is developing. And fixed income, again, the expectation is that interest rates will come down. So actually, for an investor, it's the best of all worlds.
Right now.
And if you want to participate in something like this, I think they have a multi-asset fund. So do other fund houses. So multi-asset is a big house call at the moment.
Right, and they've gotten a great tax advantage as well now. So that's a product category that's really picking up. Finally, no China anywhere. I keep getting asked this last 2 weeks. So many queries have come in, right? Because that's how investor psyche works. Saying, should we invest in China? How can an Indian investor take exposure to China? Ashish?
Yeah, so that's a great point of discussion. I think the fact that China has rallied so much has suddenly, there are a lot of interest which is coming from investors. I generally believe from a policy point of view, still all is not hunky-dory. I mean, you've seen the flip-flops that the government has done on the policy front. Yesterday, it was down 7-8%. So at best, given where valuations are, it could be a trade. But I wouldn't risk to say that, it's an asset class that people should go and allocate to. And do it only if you understand that market. Because first, getting an understanding of different sectors and markets in India itself is tough. Talk about,
People want to do the exotic, right? That's why even the regulators acknowledging that and launching a new asset class. But gentlemen, thank you very much. Very, very helpful conversation. Thanks for being here, and hopefully you will keep joining in so that we understand this new product along the way as more clarity emerges. But thanks for the conversation today.
Thanks a lot.
All right, with that, it's a wrap on this edition of Let's Talk Money. Do remember to keep following us and keep sending us your thoughts, comments, queries on the show. And of course, keep sending us ideas. Anything new you want to know more about in the world of money, we're right here. See you again next week.
Let's Talk Money